to discover, it can become the object of speculation. And far from reducing risk, it can make your risks greater. Did AIG's writing, by the way, the name you hear in the paper for these derivatives, the name you hear more often than the word derivative, and you never hear the word insurance policy, even though that's what it is. You hear the word credit default swap. Technically, it's only a small part of the world of derivatives, but we don't need the care here. So it's just a term. It's a way of somebody who's owed money to protect himself or herself. That's all it is. It's a promise. You sign a contract in which the person you sign the contract with promises you that if the person to whom you've lent money or the company to whom you've lent money does not pay you back, they will. So it's your protection. But this contract can then be sold and resold to anybody who thinks they can buy it now and sell it for more later, or whatever's in their mind, it becomes part of the financial world. And this was celebrated in the financial world as a wonderful way of diversifying risk. Let me make sure you understand, because there's a grain of truth here. It's important to see that. Suppose I'm a company and I'm sure I have a great new invention that if I can only do it, it'll revolutionize and make people healthier or happier or whatever. But I don't have enough money to make this thing. So I want to go borrow. So I go to some bankers and they all look at me, they don't know me real well. No, you're not credit worthy. Okay. Well, in some sense, the world, which might have been better off had I been given this credit, screwed up. It didn't give me the credit. Why? Because to give me credit was too risky for all the potential lenders. Question. Suppose no one of the lenders had to absorb all the risk themselves. Suppose the risk could have been parceled out to 2, 3, or 4 institutions. That's what this is. That's exactly what this is. So the bank, I'll give you an example, the bank that actually lends me the money now writes a credit default swap, but not for the full amount, for half the amount. So what does the credit default swap say? In the event that I default, I don't pay back the $1 million I borrow from you, you have a contract, right, with another bank that will pay you half of what I was supposed to pay you. So now, half of your risk has been shifted over onto that third party. You could sign a second default swap with another producer for another quarter. You could parcel the whole damn thing out. Because remember, you have to pay less for this contract, the less you have to get reimbursed in the event of a default. So it's a way of diversifying and spreading risk. Some of you go back, you'll read Alan Greenspan giving these poetic, what a wonderful thing. We have learned how to share risk. It was true. But the absurd naivete was not to understand, as with all developments, yes, it has a rationale, it has a useful function, but then the question has to be asked, what else can be done with it and to it? And then you open up the Pandora's box. We now know that did the derivatives disperse risk? They did. Did they make possible loans that would otherwise not have happened? They did. Did they get rid of risk in our society? We're living through the answer to that question. Nope. They in fact reduced risk and multiplied our risk at the same time. And that isn't unusual or weird. That's the way it's always been. Okay? All right, not too much on the details, because what will happen is you get lost in the details and you won't see the big picture. Okay, the first explosion of excitement then goes to the stock market. Drives it crazy. Everybody wants to be in the stock market. Americans in huge numbers. Lots of working class people. You know, they read the newspaper, they pay attention, they know. This is the period of time, the 80s and 90s, when an inordinate number of Americans began to pay attention, to invest money in the stock market. It was glitzy, wonderful things were happening. You could leave your money in a savings account and you got 4% a year. Yeah. In the newspaper, you were reading about people who got 50% in an afternoon. It's very hard to stay with, so you take your money out of the savings account and you go here, but of course you don't know anything here. So the wonderful thing that developed were companies that served the community of new investors who didn't know how to do this, didn't know how to select one stock from another. So these things are called mutual funds. And basically what they do is they say, in a polite way, because you couldn't say this honestly, in a polite way, "Dear average American investor, you moron. You don't know anything, you're stupid, you'll never learn anything, plus we're going to terrify you about the stock market, plus you're already scared. So here's what you do. Don't buy a share of stock, give us your money." First little red flag should go off in your brain. Give us your money, and here we have, oh you'll love this, experts, Sharpies. And what you're going to do is, you're going to give us your money, and in exchange we're going to give you a share of this mutual fund. And basically what that means is your share gives you a piece of a basket of stocks that we're buying and selling every day because we're smart and we pay attention and we know, you don't. So this is your way to participate in the stock market even though you don't know anything and you don't have the skill or the education or the time to learn. And they went nuts in these 20 years. There used to be a handful of them. Now I think there are 10,000 different mutual and some enormous number of mutual funds. And it's a whole market. There are people who specialize in nothing but buying and selling mutual funds, which are simply clumps of shares that the mutual fund operator buys and sells on behalf of the people who invest in the mutual fund. This created a whole new network of companies, employees, that's the explosion of the financial markets. So people were drawn in. It reached its peak, this idea of the market is the place to make money, when, and it came real close, folks, when it began to be a glimmer, a gleam in the minds of the stock market, that there was a discontinuous piece of explosive growth they could have that dwarfed anything that had happened so far. They got really excited. And here was the idea. And the geniuses behind this were a very conservative business group. I won't say more about it because I can't. Cato Institute. Any of you ever heard of that? Yeah. Oh, good. Them. A very conservative, but a peculiar conservative, not conservative in the usual way, libertarian conservative, very, for example, hate the Iraq War, dead against the American involvement, but very conservative folks. But they don't like government, they don't like all that. Anyway, they became the brains behind something which Wall Street loved. Here was the idea. Every year, billions and billions of dollars are taken out of American people's salaries and wages. It's called the FICA deduction, Social Security. And that money is given to the government, which basically holds it until your time to retire, and then you get your Social Security bill. You have an injury or whatever you're entitled to under Social Security. And this is a kind of, the government imposes a pension on you. It imposes on you the withholding of your money every week of your salary, puts it aside, lets it build over time, and then makes it available to you when you're 65, etc., okay? They got the idea. Well, the rate of growth of the Social Security fund is very small. It's nothing as spectacular as this. So we ought to privatize Social Security. Basically, end the Social Security system as we've known it, and create for every American a private account. And what would happen is the money that would be taken out of your salary, that is matched by your employer, the way Social Security works, would be put into this account, your name, you're the worker, but you would then manage the investment in the stock market of this. It would have meant that the pensions of the American people would have depended on the stock market. Now, there already are many Americans whose pensions depend on the stock market. That is, in the world of pensions, there are two kinds. One is called a defined benefit, and one is called a defined contribution. A defined benefit plan, which used to be the norm, but is now much the smaller one, says you work here, this is the benefit. We define the benefit you will get when you're 65. The alternative is defined contribution. This is the amount we're going to take out of your thing. Then we're going to invest it. How much you get when you retire will depend on how the investments do. the 401ks that some of you know, but that's what that is. You put a certain amount in, but what'll be there when you get old or sick or whatever you need it will depend on the fortune of the thing. There are, in America today, right now, somewhere the estimate is 60 to 70 million people in the United States today who are changing, right as we speak, their retirement plans and their post-retirement plans because they don't have the money they had last year. And therefore they're not in a position to retire, to do this or that they had planned on, having presumed that the rate of growth of their 401k in the 90s and in the first part of the new millennium, they just assumed that would continue. And it's all gone. Or a lot of it's gone. And suddenly retirement is all. And for those of you that are relatively young, you ought to be worried about this, because that means you're not going to get a job. Because people who would have retired, making room for you in a new position, aren't gonna. They can't. And it's going to make your difficulties as young people, which are already significant, worse. They're already doing that. You know, you're going to have. You may not immediately see it. No one's going to come and slap you in the face, but the same effect. And it'll hurt more because you don't know where it's coming from until I just told you. Okay. So the financial sector first focuses on the stock market and invests and buys, and then of course, and I say of course because this is in no way new. Capitalism has done this over and over again. Remember the first lecture in this class. Bubbles, burst bubble, all of that is in no way new. So the burden would be on anyone who in the 1980s or 90s believed that this would somehow this would be a ball that only goes up and never bounces down. Right? That so many people got caught up in that idea tells you something about our economic system, but also about our culture and about learning from history and all the rest of it. So it burst. Why did it burst? Because it became suddenly clear to people that the companies whose stocks they were buying might not be a good investment. What does that mean? Remember the example I gave you? I buy it for $100 on Monday, I sell it on